Yeah, thank you all for joining us today on the Sifted Talks in partnership with Stripe on how to go to market in 2024. So I'm Sadia, I am the editorial assistant here at Sifted. Today we'll be chatting about everything from the broader environment and potential challenges that startups in this phase of growth might face in the coming year, to the specifics of what founders and teams should be focusing on if they want to make a success of this quite crucial point in a company's development. So to lead that conversation today, I'm joined by Fanny, who is Head of Startups and SMB at Stripe. We've got Lars, who is a partner at Creandum, Steffen, who is CEO, and co-founder, COO, CFO, and co-founder of Synthesia.
A lot of C's.
And Ollie, who is VP Engineering at eMed. So thank you all for joining me today. Before we start, just a note to our audience that we do have a Q&A box today for any questions. We won't have a kind of standalone section at the end, so please pop your questions in throughout the session, kind of when they occur to you, and we will come to them as and when relevant. If you like the sound of a question that someone else has asked, you can upvote, and that will bump it to the top of the list, and yeah, show us that more than one person wants that question answered. So to begin, I thought that we would start a bit broad, just to kind of root the context of today's conversation. So I'm interested in hearing kind of what kind of environment do you think 2024 is going to bring for early stage startups, especially compared to the tough couple of years. I don't think it's controversial to say that, tough couple of years that we've just seen. Maybe it makes sense to start with Lars on that one. Kick us off.
Sure. Great question. 2024 will be tighter for most startups. It's going to be a focus on budgets and ability to not go over those budgets. When you have less flexibility on spending, it's going to be harder to execute. It's going to be harder to have flexibility when it comes to hiring, when it comes to marketing spend. So then, as investors and board members need you to deliver, it's going to be more pressure on most startups to actually handle this situation. With few startups that are doing very well, they can live by different rules where that flexibility is greater since they're overachieving. But for most companies, they're going to have tougher times.
Yeah, I think like just to add on to what you're saying, Lars, is I think like we entered 2023 and especially like, we talked to a lot of startups at Stripe, like a lot of apprehension in terms of like the market, the investment levels. And actually like Europe is still really strong when you think in terms of investments versus other regions. I think like both early stage and late stage, actually like we've seen signs of robustness. So I think like while everything you say is true, I think like the onus on profitability and revenue models is not going to go away. I feel like there's a little bit more room in terms of thinking, what are the next big industries that we want to bet now? I think AI is a really good example, and Steffen, you can talk through that. So I think it's also like depending on the sector that you're in as a startup, I think the picture can look quite different. But I'm personally really excited about 2024. I think actually like while it was a really tough environment, I think it's raised the game for a lot of startups in terms of how they think about profitability, hiring, scaling, and really thinking about like what are the smart decisions I do early, to really put myself in the best position with investors. So I think it's also going to be a really exciting year in the startup scene.
Yeah, I totally agree with that. Should I go or you want to go?
You go, Steffen, you go.
Okay, yeah, I totally agree, Fanny, and also with you, Lars. But on the kind of cost side, right, there's also just coming a new suite of tools that really allow small teams to be incredibly productive. And I think that's also kind of a major wave in how early you can kind of turn profitable in the journey of a startup. If you kind of apply many of these kind of new techniques to really kind of, get operational leverage as a kind of small team, applying many of these kind of new AI tools.
Yeah, it felt like a few years ago, all you heard about was sort of companies growing really quickly and growing their teams massively and going from 100 people to 2,000 people in a couple of years. And then a focus on sort of bringing in lots of revenue, but without a really clear path to profit. And it seems like it might have shifted the other way, and there's a lot more emphasis now, certainly from my experience here, of trying to have a much clearer path to profit without it just being purely on revenue. And also, like you say, there's a lot of high-profile cases coming out from the technology angle. There's a lot of high-profile cases of people shrinking technology teams at the moment, and there is a definite pressure on teams. It's probably not just technology, but all across the business to operate with fewer people. And glad I wasn't the first person to mention AI, but AI will be a factor in that, but it won't be all of it. And there's still an ask to be more efficient with fewer people generally, which is a challenge, of course.
No, definitely. And you kind of mentioned a few there amongst yourselves, but kind of with that environment in mind, what would you say are kind of the main struggles or barriers that startups looking to go to market in 2024 might be facing? What do you think founders are sort of most worried about right now?
I can go first again, and then I will let other team members speak up first. I think the typical characteristics of a successful startup will come to fruit also 2024, but it's going to be more crisp and clear. So the team that the startup is able to hire early will matter even more. There's not a lot of flexibility, as I said earlier. So more pressure on hiring, coming up with a diverse team that's well educated with some experience as well. The total addressable market for the category that you're approaching is going to be important. If you approach a niche when you don't have the flexibility that you may have in a better economy, that puts more pressure on the segment that you're into. So as you build a startup, make sure that your TAM is large enough. Otherwise, you may fight uphill. Then, of course, your solution, the timing, don't go too early, don't go too late, since you don't have probably enough ammunition. In a different economy, you can spend more money to catch up, or you can buy time until the market is ready. But timing 2024 is going to be more important for a smaller company.
Yeah, like I totally agree. Like timing is everything. And I think like, you're a bit, like chicken and egg. I think when you start a startup where you're like, I want to monetize really quickly, but I want to have the right product and I want to do it at the right cost as well. And I think that's why, like, when we talk to user, the thing that they're telling us, again and again is like they need to find the right support to scale and do it really quickly. I think as well, like before, like startups were a bit more focused on their domestic market. And I think now, like if you get an example of a user we worked with recently, their name is Photoroom. I don't know if you know them. They're an AI photo editing company. And actually, like from the get-go, they said, we want to monetize quickly, but really go international really fast versus maybe, I think, an approach, which is, we do it domestic, we kind of get used to what we're doing and then we expand internationally. And I think like for them from the get-go, they wanted to go global and really think through around, how they do tax, how they do invoicing, how they do subscription really quickly, so that they can really avail of that global market. And again, I think it goes back to like, monetizing quickly so that you can show those run rates to investors and be able to hire and like build your resources as well as you go on.
Cool. Steffen and Ollie, did you have anything you want to add on that?
I guess
I think
speak out.
You go this time.
One of the challenges at the moment seems to be that technological advance in a lot of areas seems to be happening quite quickly, and so I think for smaller companies entering either new markets or creating markets, in some cases there's a lot of competition that comes up really quickly. So you go from a sort of almost no competition market to lots of competition quite quickly, and that causes pressures on not just customer loyalty, how to grow the customer base, but also you put a lot more emphasis on trying to sort of retain the customers that you've got, and pricing becomes like hugely important there. I don't talk a bit about pricing, but Suddenly, if you've got lots of competition out of nowhere, then suddenly everyone can just try and compete on price, and then you need to find other ways of competing. So we operate in healthcare, and in healthcare, price isn't everything. You know, you need to have good trust with your customers and your patients, and if you're selling a product that is fundamental to someone's health, then they need to know they're dealing with a company that they respect. But equally, there are always going to be people who will enter the market with a lower price point, and that's going to take some of the customers away who don't value some of those other things. But I think you need to, depending on what part of the market you occupy, and we tend to occupy the bit of the market where we are maybe a bit more expensive, but have a more established clinical and trust model, then you need to sort of really sell those parts of your product through your marketing, through other things, because otherwise you're just going to lose out to lower price people.
Yeah, I think as well, like maybe to add on to what you're saying, like the agility, it needs to be like really, really high, because to your point, like tons of competition, like especially on the pricing side, actually, like there's so much movement around how, you know, companies think about pricing. And we've done a survey recently, thousands of respondents, and like it was really interesting to see 40% of the decision makers, they said we're going to change our pricing model going into next year. And so like that puts a lot of pressure, I think, on other companies as well to think through, you know, I need to be ready really quickly to iterate on, you know, moving a couple of euros up and down, changing the subscriptions. And I think that's something you've done like very recently, Ollie, on like, hey, you know, you need to iterate, and then like be able to adjust really quickly, because there's so much competition. And also, like, you know, you're trying to understand your users and you know, what's the perceived value that you bring to them, and like that needs a lot of adjustments, I feel, to get it right, and not be like, you know, stuck in a place where you say we've got it now, but like really think around how things are moving around it.
We're trying to be really data driven with how we do that as well at the moment. So not just sort of gut instinct and assuming you know what's best, but trying to change not just pricing, but, you know, how you market to users, what messaging you have, how you get them through flows. And the product we launched last year was weight management medication, and it's a really competitive market, and part of our sort of broader chronic care offering that we try and emphasize the broader offering, but we're learning so much through being data driven about how you message that to people, and how pricing has an effect and how other things have an effect. But it's quite an interesting challenge, because you have to throw out your preconceptions. You have to really trust the data. You have to say, right, I might have a hypothesis about that, and I might be convinced that it's the case, but if the numbers don't back it up, then I have to get rid of that hypothesis. It doesn't add up. And I think the earlier you can build that into your processes, it seems to be, certainly for us, like the better. You know, it's a difficult mindset to have in a business where everyone thinks they know best, naturally, as humans, I suppose. But the earlier you can build in that real like data-driven culture and all the tooling and the technology you need to do that, the better, and the more you'll learn.
That's super interesting. On the topic of pricing, in fact, you kind of mentioned there, Ollie, sort of how you work out what your pricing strategy is going to be, and kind of, I guess, equally as important, how do you test if that pricing is working well, or if you're sort of on the right track? Steffen, I wondered what your sort of experience in that was as well.
Yeah, I think it's pretty stark that when you see companies spending, you know, multiple years of developing a product, and then they're like, oh, let's slap a price on in the end. That's kind of, you know, typically how most people does it. And like, oh, let's try this price and kind of, you know, what that feels right. But I think having much more deeper assessments of what is the actual value you're driving and what is the outcomes that the customers is kind of, you know, driving with the tool or the offering that you're providing, and having really kind of a first principles kind of mindset to what is it that it actually is worth, and what is the customers perceiving that as. That might also be quite different, what it actually is and what the perceived value is. So kind of doing the groundwork of trying to actually do a lot of this research before you develop a feature, before you develop a next kind of, you know, product offering. What is the actual problem, and how valuable is that problem to address, and really try to kind of derive a price point from that. There's obviously other kind of market dynamics and competition that factors into some of these decisions, but I think having a bit more of a upfront kind of thoughtful approach to pricing, as opposed to kind of gut feel after you kind of spend blood, sweat, and tears for 3 years to kind of develop something and then slap a price on in the last minute. We should probably spend more time upfront on pricing.
And
I think pricing. Go ahead,
go
Fanny.
ahead, Lars.
No, you take it.
Yeah, and I think that can be really tough actually, because to your point, you go out with your pricing and you're fully convinced this is the right entry point. And I think to your point, Ollie, you need to be kind of moving out of your preconception. And if you fail, it's fine. You just need to make sure that you fail fast and you iterate. But that can be a really tough thing, I think, for founders after, to your point, many years of thinking, this is the right place for the pricing to be, and actually realizing it isn't. And how do you change tack really quickly?
Yeah, slightly improved pricing, let's say 30% higher pricing, will generate 30% more ARR. Imagine how much time, how much effort you spend on the organization to generate 30% more ARR. So if you're growing at 80% year over year and you want to push it over 100%, that's not easy. The pricing is one tweak, but it's very hard to change the pricing after you have set it, since customers are used to that, they are renewing, they expect that pricing to stick. So my recommendation is to put a lot of effort into pricing from day one and have a dedicated person or a team that knows the market, knows the competition, knows the value that you provide, since it is harder over time to change the pricing. And there will always be people, especially salespeople, pushing back on any change to pricing.
That's interesting. Do you think that's I suppose you've got sort of one-off product sales, and then you've got subscription type models, and the temptation of the subscription models is always to start at a lower price or a discount in those early months to increase the initial uptake, and then that gives you some time to prove your product value before the next price increase kicks in. So that's one option. Do you think there's I don't know if I'm asking questions here. Do you think that that's a valid model, or do you think it's you just start at one price and stay there?
I think it's obviously you need to change the pricing. You need to experiment to get an optimal level where you provide enough value to the customer to address that price point. And if you overprice, they will not be happy. They will seek other solutions, and you will eventually see some churn. But when you apply new pricing, then you set the new tone, and the customer may not have the budget. They have already forecasted the price point throughout perhaps the next coming years. So then you can choose to apply the new pricing to only new customers, but often you have a large enterprise where you get a new project, you get a new initiative. So then do you apply the new pricing to the new division? So it becomes a little bit more complicated. Then obviously you got to do the right thing. And I think going too high too early is very hard, since then you don't know what's wrong. Is it the pricing? Is it the team? Is it the product? Is it the market? If you go too low and you increase over time, then likely you need to treat your early customers with respect, and they got a good deal that you may need to maintain for years.
Yeah, and I think the experimenting fast at the beginning is really important, but to your point, once you're at critical scale, it becomes harder. And I think that's also where startups need to have a path to the new revenue models, or to the enriched offering that they want to put in place. So there's maybe a V1 of the offering, and say we want to continue up the value chain. And one area where we've seen users being really successful is also how they think about monetizing payments, and that's enabled them to add an extra layer of value to their users. And I think those are the times where you can kind of reevaluate your pricing and think about, okay, we are providing additional value to our users. And so how does that evolve over time? And so I think you do need to have that roadmap of thinking, that's our starting point, but also if this goes well and we want to increase the value in the offering, what's the path looking like? And those are kind of milestones, I feel, where users can take a bit of stock as well, and maybe, to your point, Lars, make those changes easier, especially if they've started to have a bit of scale. And yeah, maybe salespeople that complain about, the offerings changing. And once you have the value to show, I think it creates a totally different discussion and perception to your users as well.
I think that's super interesting. I think something you've kind of all alluded to, I guess, is like the product messaging and your marketing and what you're communicating to customers. How important is that kind of element of the business at this stage, and kind of what are the consequences if you don't get it quite right?
Not a lot initially. I think you can do a lot of experimentation in the early days of the product. Of course, I agree that it becomes harder and harder, but I think it's important to keep an open mind because the market dynamics might be very different today than when you started the company a few years back. So it's not just kind of having a static one size fits all. You can also experiment geographically with different pricing. You can experiment with other things. So I think it's a topic that needs to potentially get a little bit more attention than it has today.
It needs to, I guess it needs to be consistent at an early stage with the business strategy and product development. If they're not in line, then you'll be building products that don't necessarily match the marketing strategy, and even if that's a bit out, can become quite difficult maybe to row back from that after a few months if the marketing is not in line. I think in our industry in healthcare again, the messaging is quite important around trust, and I suppose it depends on what you're selling, but if you're selling something like healthcare, the marketing early on and the messaging that you give to your people is you need to make sure is in line with what they expect from a healthcare company, which is that you have highly qualified people and that you're regulated and that they can trust you. Because if you're a digital first model in that market, you just have the internet and some websites, frankly, that people go off in the first instance. So you need to make sure that you're getting that messaging across. Maybe it's not as important in other areas in those early days, and you can adapt it a bit more, but you need to make sure that messaging lands.
Yeah, I think product marketing is hard. It's very difficult to find superior product marketers, but they have such an impact on your company. They make everything easier. If you have a complex product, let's say within AI, then if the persona, the audience do not understand what you offer, everyone needs to spend so much more effort to make that clear. Field marketing needs to spend a lot more money to make the message sticky, but still people internally, people within the market are all confused. But the right product marketer makes it so simple. But it's very hard to find that person that can deliver that message. But this is probably one of the most critical roles, because you usually would overspend on sales and field marketing to make up for your weak message that few people understand. And then of course the message may change over time as you expand your buying audience. You may change from one buying persona, let's say a developer, to then an architect or to an IT executive. So then that messaging needs to adjust over time.
Yeah, and I think also a pitfall, I would say, of that product marketing is to talk too much about your product and not necessarily enough of what it does for you users as well. And so I think there's this tendency of saying we want to talk about us and our product because that's what we're really proud of and we want people to know about. But actually, it's really the other way around that you need to look at it and think through, what is it bringing to people, and does that come across your messaging, your marketing, your website, and what are you proposing to them to see that as well? And I think on your website, Steffen, there's a really good example of you can actually do a free video of what it looks like. So very quickly you get people to go into the platform and experience it themselves. And I think that's also something that's really important to get people to experience the magic that you're creating as a startup. And how do you do that? I think it's there's a really interesting analogy where people talk about when you're at a dealership and you're trying to buy a car, the salesperson that's selling you the car is going to try to get you to touch the car or sit in the car or kind of get you to experience it. And I think in a digital model, you do need to think about really creative ways of how you do this and making it very easy for your users as well. And I thought, Steffen, that was a great example of how you can do that.
Yeah, totally. I think that's kind of been critical for our kind of growth wheel is to, and I think it's getting even more and more critical, right? For new offerings, you need to give much more away for free today to really kind of entice, to really inspire, to really kind of get people excited about some offering versus maybe a few years ago, you could kind of go more kind of direct with a much more kind of, top-down motion. I think you need is, especially depending on who you're targeting, right? But I think you need to be giving a lot of kind of value away in the early journey of the customer relationship before you can kind of own the credibility to actually take on a longer journey and a longer path with these customers. So we just launched freemium, for instance, last week. So users in the UK can try freemium at Synthesia.
A nice little plug there. Super exciting. So I think one thing that we've sort of referred to throughout the kind of last half an hour is the customers and the audience. But to kind of get to the core of that, how can founders and startup teams actually identify what the right target market for their product is? Kind of how do you find those people to give you the feedback that you need at this point?
That was a tricky question. No one wants to answer it.
Yeah.
I suppose again it was going to matter by industry, isn't it? And finding the target market is, there'll be, it depends on where you start from, but if you've established some sort of subscribers or customers already, then you can learn a lot from who you've already got, and hopefully you don't start from zero. Hopefully, well, everyone has to start from zero at some point, but hopefully very early on you can work out some patterns. And again, if you have the data to back that up, then you can learn things about your target market quite quickly. I suppose you don't want to make too many assumptions too early on. If you've not a huge customer base, you don't want to jump to too many conclusions. And again, if you can be data driven about learning as much as you can about the sort of customers you have and the sort of people who are interested. So equally, if you can be flexible and agile in your marketing strategies, maybe that's the approach, is to try things, try different marketing approaches, try different platforms, try different targeting of different user groups, and see which one works. Because again, you could assume that you have a target market out there that is not the target market you think it is, and you might be missing a completely different target market for reasons that you don't really understand. As someone mentioned earlier, you spend a lot of time building a product, you have such a vision in your head of who's going to buy it, and you might be wrong, and that's not the end of the world if they still buy it.
I would probably add here that if you don't have a unique insight about your target market, you'll probably have a very low chance of success. So you probably have at least to do a lot of groundwork, or have been working in an industry for many years to kind of develop a unique insight why there is actually an opportunity in the market. If you're kind of, it would be cool to add something to this industry because it looks arcane, that's probably not the right strategy to start a company.
Yeah, I think the groundwork is really, really important. And to your point, like sometimes you have a big customer base and maybe it's easier to do. But I think also, like, if you think this is the kind of size of, company or the type of people or like, the use case that I'm looking for, I actually think like, surveys and kind of like trying to get data on what you're trying to do is sometimes, I think, a tool that's underutilized. And I think like at Stripe, a really good example of it is, as we think about like the next products that we want to develop, we spend a lot of time with our users asking them what hurts and like what's really complicated. And a couple of years back, like users were saying, 2/3, I would say, of our users says tax makes it very, very complicated, to expand globally and like for us to get to new markets. And that's really how, we thought about how about we create a product that does that, and like spending time with those users, understanding what exactly is really complicated, how long time does it take you, and how can we solve for that. So I would say as well, like once you start having those unique insights that Steffen, you were talking about, like how do you validate them and you make sure like they not just in your head, but they're actually like, felt by many, and that I would say the impact is big enough for, users to think, I would purchase a product. And that's also the price that I would pay for that product. I think like that groundwork can be incredibly valuable, and sometimes like going a little bit slower can actually make you go a lot faster, I would say, once you go to market.
I think a lot of startups end up with a product initially, and then they try to look for the market or the segment, and it should be the other way around, as the panel members mentioned. Find that problem that you experience yourself, and then come up with a solution to that problem, and make sure that the problem is within that broader total addressable market and not just a silo issue, but find the problem and then come up with a solution rather than the other way around.
Great, I feel like that's some solid advice there. Just to go to the kind of Q&A box. So one of the questions that Lawrence has asked is growth and profitability. So I feel like the balance between that is, you know, hot topic at the moment. At this point, should founders focus on growth and profitability in equal tandem from day one, or is growth the kind of name of the game at the moment?
I think it's very classic when the market gets tougher, then it's back to basic, where profitability matters big time. In a more positive economy, like 3 years ago, then few investors would look at profits as a core ingredient. They would rather take growth and market traction. But it's a hard balance, since today we're facing a very exciting market opportunity going forward, where many startups today that are getting built will become the very large companies in 5 years. Since it's a tighter way to build a company, but when you build it with a tighter budget in place, that's when you actually build a very efficient rocket ship. When you build a company in the heydays, then you spend just more money, you hire more people, and then you get into trouble over time. So yeah, it's an interesting one.
And the tough answer is both. And
yeah, I think like it's also like I know it won't satisfy the audience if I say you don't have a choice, you need to do both, right? And like it is really true in the world of what we are today, is that you do need to demonstrate that you can do both. And also I think like there are some opportunities that you really can't miss in terms of profitability. And so even though you say, oh, we really focus about growth and we really focus about our product, like there are areas where, you know, you just need to optimize from the beginning. And I think a good example of that, you know, if you think for a user, Papier, that's, you know, that was thinking about like, you know, we want to scale like really, really quickly. But actually there's a ton of friction on fraud, money movements, like authorization rates. And that seemed quite prosaic, I think, to a startup who's like, you know, thinking big and thinking actually, you know, I want to grow for 400% or like 300%. But actually the fact that they got a really sound, you know, payment system from the beginning, that's what really enabled them to think, for one, the growth comes, we know we're just not going to like hemorrhage money, that we can save and reinvest into our R&D and our product as well. So I would say as well, like there is no cutting corners. I think every decision that you make needs to be anchored around, is it paving profitability? Is that the best decision that we can make today? And also like, is there, you know, is it a trapdoor decision or can you change later? And I think sometimes a lot of founders can sometimes think, you know, all my decisions, I need to make them for the next, you know, 5 years or 10 years. And that's really important. But actually, if you have this, you know, mechanism, like, you know, we can revert back, we can change, that makes a lot of difference into the decisions that you really want to, you know, spend a good bit of time on and a bit of focus. And the ones that you say, you know what, if we get it wrong, you know, we can backtrack as well.
Key is to get the formula. Key is to get the formula right.
Yeah.
If you can present to investors and to the board that your formula is correct, meaning that even if you burn money today, it can be a lot of money. You can show that quarter by quarter, you're moving towards profitability. And some investors value awareness, adoption more than profitability in the early days. But eventually, most companies would need to get to that path of profitability. But if the formula is correct, some investors would support you even if you burn $100 million per year.
Yeah.
But then that path needs to be crisp and clear, and you don't have a lot of flexibility in the today market. So if you haven't figured out your path, then you should burn a lot less.
Yeah,
Oliver?
I'm the least qualified to answer this question in this panel, by the way. But I wonder if the argument is that it's where your growth is coming from and where your sort of lack of profitability, I suppose, in the early days. So if you're spending if your cost of acquisition, for example, of your customers is very high in the early days, that might be okay. It might look unsustainable, but if that cost of acquisition is coming down over time and your spend on marketing doesn't need to be as much to get the same customer base, and that therefore you can see a sort of trend in that direction. And then, like as you're saying, Lars, if the sort of key thread of the company is strong, so if the fundamental business model that you're working to doesn't have a convincing case for profitability, then you're probably not in a good position. But if you can prove that early spend, you will need to spend probably money, or you can spend money early on, more than you might be comfortable with on marketing, on perhaps taking a hit on the pricing in order to build up that initial customer base. But if your cost of acquisition of customers is coming down, then that's a good sign and trending in the right direction.
Super interesting. I hope that answered the question. I think it did. So kind of going back to thinking about that go-to-market strategy point in a company's development, I think it's particularly important at this stage to make sure that everyone in the team is on the same page. And this is something that we talked a little bit about when we spoke last week. So yeah, as a founder, how do you make sure that all of the team is aligned on the same strategy, everyone on the same page, and they've all got the same mission in mind? Maybe Steffen or Ollie, as people kind of working within startups, maybe one of you could kick off with what your experience was.
Well, I think from the engineering perspective, so obviously if you're working in engineering, you need to make sure that the communication is just so, I mean, it sounds obvious, but the communication is just so important. The messaging that the go-to-market team is sending out or thinking about on a day-to-day basis, it's quite easy sometimes to have meetings with one team where you're evolving your thinking about the product or how you're marketing things, and then you don't necessarily communicate that effectively to the rest of the team. That's easier. That's an easier mistake to make when you're bigger. So it becomes harder the more people you have. So I suppose that's a benefit of not over hiring, which has been mentioned already, is that communication is easier. But you can't really overstate how beneficial it is just to keep repeating the message and the central thread of what you're trying to do, so that the marketing team, the technology team, the product development team, everyone is on the same page. And it's a simple message that you can just keep communicating throughout the organization. You can you say it once every few weeks, and you sometimes think you've done the job of communication, but I'm learning quickly that that's not the case. You need to keep saying it over and over again.
I agree, and I think it originates from a very clear and inspiring kind of mission statement, why you're doing this and for what reasons, right? And that should ideally kind of permeate the entire organization, right? Where Tesla transforming like the information, kind of the world's kind of mobility into electrified motorized kind of vehicles, right? It's just so easy to understand for everyone in the org. Where we also kind of trying to do some of the same things at Synthesia, where we want to kind of make everyone able to kind of create a Hollywood-style movie on their laptop. And it's just very clear for everyone that is kind of, the overarching goal of the company, and that kind of permutates on a yearly level to kind of quarterly level. And that just makes much more clear in kind of roadmap decisions and the direction of the company. And especially as you scale, it just becomes more and more critical that you can't micromanage and you can't sit with every new employee and make sure that they understand every minute detail of your product roadmap or details, right? So it has to kind of have some of those kind of overarching guidelines and guideposts that can kind of get people to run in the same direction, right?
Yeah, and I think as well, like, you know, in terms of like maybe the environment becoming tougher in terms of, you know, investments, the onus on profitability, like I've been chatting to founders, and I think like a lot of positions that I've heard is actually very, very honest and candid transparency as a team, and really think like, you know, yes, I'm the founder, but we all, you know, building this company together, and kind of like the concept of radical candor, like the founders are sharing like very, very detailed views of like, hey, that's what we are, that's our run rate, that's how much we're spending, that's like where we need to get. And I think this over communication has really, I think, like lessened maybe the anxiety of some people that are working in those startups and thinking, what is tomorrow made of? And really thinking about the driving to, you know, the same mission, which Steffen, you were talking about. So I definitely think the trend that I'm seeing is transparency, over communicating, and making sure like you're not losing anyone as you grow and iterate. And obviously that becomes more complicated as you grow, and it's not just 20 people, but suddenly like it could be 150 people. And, you know, you need to constantly, I would say, adjust on what great communication looks like. And it's different depending on the stage of the journey that you're in as well.
And I guess on that note, like how can investors help at this stage? What sort of things can founders ask them for that would be kind of helpful resources? And maybe as our investor representative, Lars, I'll go to you first.
Sure. If I look at my 12 years at Neo4j, a company, graph database company that we built from 0 to 150 million ARR, and it continues to grow rapidly. Our investors provided a great ecosystem of people to talk to, since every day you're facing new challenges as a leader, or even as a founder, even more challenges that are new. And by speaking to other founders, speaking to other companies that are in a similar situation, because everything we do when we build a startup has been done likely before. Maybe not that product, maybe not that specific problem, but from a GTM point of view, everything has pretty much been done. So an investor usually sits on a network of people that are very much willing to talk to you. And in Silicon Valley, where I spent 20 years, the entry barrier to speak to other people, even very successful people, is not high. People are open-minded. Even here in Europe, people are very open-minded. If you reach out and explain that you want to speak to them, you may only get 10 minutes, but you will likely get the 10 minutes. And investors can help to broker that channel. So get the right investors that have a pool of talent that can help you to become successful. I think that's a key ingredient that investors can help with money. But I think the more important thing is to get you to network with other people, peers that are in a similar situation.
These investors can help with setting the KPIs in the early stage and you know, making sure that they're aligned to them. So to come back to this point that was the question earlier, if you are, depending on what your metrics for success are in the earlier days, whether it's just building that customer base or whether you do actually want to see profit, or whether it's the cost of acquisition or whatever it might be, if you need everyone to be agreed on what the key measures of success are. So if you've got certain people who are invested who have a different view of what those metrics are, then that's going to cause different decision making, I suppose. So maybe that's one way to sort of, for investors to help.
Cool.
I think for me, I think it's just all about hiring, getting the absolute best talent on every position is just so critical. I think that's probably the key differentiator for us. I don't think they'll have much operational input because the context is so kind of unique and so difficult to kind of keep up with, but more on the hiring.
Amazing. And just go to another question from the audience because it's sort of related to what we're currently talking about, I guess. So Sheng asks, with a higher focus on profitability rather than burning money to grow, as we've talked about today, will bootstrapping become a kind of more popular or favorable option for founders in 2024? What do we think?
I don't think it's a more favorable option, but I think many companies are facing that reality. It is harder to fundraise today, and you need to provide all the ingredients to get an investor to sign up. So therefore, many more companies will struggle in a tighter economy. Then obviously, if you get an investor on board, they will do everything to help you, since it's going to be, everything is tighter 2024 compared with 3 years ago. But is it a preferred approach to go with a bootstrap model? I don't think so. Since the time to market is critical, everything goes faster and faster and faster. So if a competitor will a well-funded model compete with you, you will likely have no chance. So I think get your act together, have your team, know your TAM, know the competition, have the right timing and all that stuff before you fundraise, and then you move fast.
Interesting. Fanny, do you agree?
Yeah, it's interesting. Like, and I speak to funded startup users who like obviously go very hand in hand with their VCs, and like I've chatted as well to startups that have bootstrapped, and like I think what struck me is like there's a bit of a philosophical difference between the two types of founders to a certain extent, and you know, bootstrapping is, you know, I think something that obviously you know, maybe more necessary as we are in this market. And so I think a lot of people are starting to think, you know, maybe I could do this. And you can be very successful, I think, bootstrapping. But I think to Lars' point, it's a matter of timing. I think if you're starting to bootstrap and you're starting to see an amazing trajectory, and it's, you know, it's kind of like keeping pace with what you want to develop in your startup, like you have an amazing autonomy in terms of the direction that your startup is heading into. And so that's brilliant. I think in other places, it can be harder to bootstrap because actually you need that investment up front to create the product that you need. And so like it's a very different model of, you know, if you have a model like, you know, some user I was chatting with, which was a platform around, you know, short stays in hotels. And so they're able to monetize really, really quickly. And so for them, bootstrapping actually made a lot of sense because they were able to get investments really quickly. But I think for other models, and maybe AI is a good example of it, you know, do the product that you have in mind, do you need a little bit more at the beginning to make sure it gets to the stage that you want it to be? I think it really depends on your use case and the business model that you're into. And again, like your philosophical, I would say, preferences. And again, I think to people who want to bootstrap, what I would say is, you know, I'm really thinking about the business model that's going to get you to bootstrap successfully. And so I think like, you know, subscription is a very proven avenue of monetizing quickly, something that you're doing. And we see like in the AI industry that I was chatting about, 70% of companies have leveraged billing and subscription, doing it with Stripe as well in terms of, you know, usage-based pricing, subscription, like sending their invoices as well. And I think like for them might be an easier avenue. But again, it may not apply to, you know, another company. And again, I think the partnership with a VC can be incredibly fruitful as well. If you're looking for, you know, a sounding board and, you know, someone who has been through, I think a lot, and like a lot of VCs as well have incredible experiences as founders, as you do, Lars. And I think like that has also an incredible value. So I would say both avenues I think can work, but it depends on your use case and ultimately, you know, what's the kind of partnership that you're looking for, and do you want to do it all on your own, which is absolutely fine. And I think like they make for absolutely great stories as well. But I think, you know, partners and VCs as well can be incredible partners to startups in their growth and, you know, taking them to the next level really quickly as well. So there's no right or wrong, I would say. It really depends.
Great, super helpful. So thinking about that kind of go-to-market strategy in 2021, so kind of big year for startups, we had a Sifted article actually that said that while there's no universal way to measure if your go-to-market strategy has come to a successful end, a handy metric is, quote, when a company grows their revenues by more than 10% month on month, and the return on your marketing investments is higher than 2. So my question for the panelists today is, do you think in 2024, is this still the case? Is that still a handy metric to go by? And if not, how has it changed? How can teams measure if their go-to-market strategy has been successful?
I can start. I don't think there's a single metric that you can rely on, but I think the one you referred to is a good one, if not a great one. Rule of 40 is another one that often finance people, CFOs, are using, where you look at the annual growth, revenue growth of the company, and you add on your profit margin. So likely early, you're growing perhaps at 80, 100, 180%, but you have a negative profit margin, and you want to stay over 40. Is that a single metric to rely on? Absolutely not. It depends, and usually you would rely on this one as the company is starting to grow and achieve 3, 4, 5 million in ARR rather than when you're very small. But I think there are other metrics to look at as well that are less tangible. Customer success is one. Are your customers happy? Is it easy to sell, or are they actually buying? You want the customer to buy, you don't want to sell. You don't want to have a cost of sale that's high. If you need to push your product to the customer to get them to buy, that itself is a problem. If you need to rely on very expensive salespeople and sales engineers and an entire team, then nothing wrong with that, but that's a more risky model where you need to have your formula figured out in detail, since you're going to have a much higher cost structure and you can hit surprises. At the same time, if you go after bigger deals with customers, bigger commitments from customers, then usually the timeline is longer. So you burn a lot more cash until you get to a break even with that customer. But there are so many metrics to look at, CAC, LTV, and so on. And I don't think there's a single one that's good enough. I recommend a dashboard where you may agree to a dozen, 2 dozen metrics that you stick to. And then you come up with a 3-year plan. You get that plan signed off with the board. And then you get just very aligned with that plan. And if you have surprises on a quarterly basis, then address those issues right away. Don't just wait another year, since then that's when you get into deeper water.
Yeah, and I feel like at the 2 sides of the coin, which is really important work, is first, what are the indicators? And I think the more leading indicators you can get, the better, because revenue is an output. What are the leading indicators that are bringing you to revenue, and cost obviously is part of it, which could be like, you know, what's the year-on-year growth of the visit on your website, for instance, or, you know, what's the conversion rates of your user from, you know, signing up to actually becoming a paid subscriber. So I think like getting those leading indicators so that you're able to see a little bit more into the future versus the revenue output. And then the second as well is, as you scale, it becomes harder to get that visibility. And so I think that's also something that's really important for you to think about, like the reporting. It seems like a big company problem, but actually the earlier you get it nailed on, the better, which I think is what you're referring to by having like, do you have that dashboard of like really crisp data, and are you able to see very quickly, you know, what are the green indicators, what are the orange indicators, the red indicators, is really, really important to drive your decisions.
I suppose going to market is a tool to improve some of those other business metrics that you want to change. So I think the quote was around having consistent revenue growth month on month and having marketing spend as a reasonable level of how much money you're bringing in, which is obviously great. But then you might see, to Fanny and Lars's point, you might see from a dashboard of metrics that you've got a problem with customer retention, for example, and then you might need to look back at your sort of go-to-market and marketing strategy to do that, because it may, there'll be lots of reasons for that, and hopefully you've got a product that you're engaging people on and they're staying on, but marketing could be one tool to help change that metric. So it's not that it's going to end just based on that. I think it will be a factor in lots of different metrics that you might want to keep track on over time.
I think a common mistake is that most people think all these relationships are linearly. So that means that, because the first early users cost me $1 to acquire, they will forever kind of cost me $1 to acquire. But there is just a very kind of natural kind of bell curve around adoption. The earlier customers will naturally be more easy to kind of acquire because they are more kind of higher propensity to kind of adopt new technology and try new things, where the late majority or the bigger kind of bulk of the market will probably need more convincing, much more credibility, much more kind of, social proof. So it's also just important that you don't kind of get too obsessed with some of these static metrics that sound good in a boardroom, because they also kind of change a lot in the course of the business.
Amazing, thank you for that. I feel like that's as good a place to end as any. So thank you to everyone who joined us today and tuned in. I hope you've taken away some valuable learnings about how to nail that go-to-market strategy and kind of where your focus should be as founders. Thank you so much to my panelists for your time today, and for some super useful insights as well. And to our partner Stripe for their support. Make sure you tune in to our next Sifted Talks, which is on January 30th, where my colleague Tim Smith will be revealing how to create the dream workplace for Gen Z talent. I think he described it as, will a Zendaya cutout make Gen Z join your workplace? So you can find more info on that and other upcoming talks at sifted.eu/talks. So yeah, thank you everyone again for tuning in, and thank you so much to our panelists today.